Welcome to the President and CEO Focus on the Middle Market podcast series, where President and CEO founder Paul Stukel discusses middle market issues with business leaders from across the nation. Today, Paul speaks with Jeff Kilrea and Tom Hobbis of middle market lender CIT's Sponsor Finance Group about the environment for M&A and expansion in the middle market in 2014.
I listened to your interview, I believe that was Jeff, and was taken by a few things in terms of your perspective for 2014. I think the biggest one is we've been hearing that the market for M&A activity within the middle market is supposed to be very, very robust this year, in the sense that there's been this massive pent-up demand. I mean, for several years, people have been saying, this is going to be the year, this is going to be the year. And the sort of confluence of events in terms of low interest rates, lots and lots of money on the sidelines in terms of the private equity world and also the corporate world, and a reasonably growing economy, that there was going to be and the aging of the baby boomers, a lot of whom own these kind of companies, was going to create this sort of rush of M&A activity. And it was very interesting for me to hear that Jeff stated in his comment that CIT views the M&A market as flat to down. Now, is that sort of a question of the timing of that conversation, or is that sort of how you view the M&A environment in 2014?
Well, that comment was if I'm not mistaken, we chatted in January, so it was a January comment, and it was reflective of 2013. But I would say if we're talking into Q1 of 2014, I believe the two biggest contributors to leverage finance, middle market leverage finance, have been refinancing and dividend recaps, which suggests to me that M&A, that this pent up demand and the aging baby boomers and the favorable economic climate with low interest rates and tons of liquidity haven't really driven M&A activity to the levels that we think. And maybe one of the drivers is some of these sellers, these aging baby boomers, they're sellers. They've also invested in their companies at very high multiples. Let's call them circa 2007, 2008. So they're sitting on companies that they paid 10, 11, 12 times for, and they're in a slow to moderate growth economy, and they're not going to get that type of exit multiple. So I still contend that M&A activity, at least middle market M&A activity, hasn't reached those the levels of expectation that we're all hoping for.
Just out of curiosity on that point, do you have a sense that multiples are beginning to rise, valuation sort of tolerance is beginning to rise, or is it still, because that's obviously been one of the excuses is probably the wrong word, but that's been one of the explanations for sort of the deferral of this supposed explosion of M&A activity, is that the sellers have had sort of unrealistically high expectations with respect to valuation. Do you see that lessening any, or do you see the buy side coming, sort of a little bit higher in terms of their valuation perspective?
Well, I guess I'd break that into two buckets. Number one would be the higher growth businesses, the ones that are more predictable, that have recurring revenues, that have defensible market positions. Those businesses I see getting bid up, and I'll just say when a quality business, and I'll say the private equity guys have probably gotten a lot smarter in the last few years. So if they're buying a business that has a higher probability for growth, they are paying up for those businesses. I think both Tom and I have seen things anywhere from the 8, 9 to 10 times for quality non-technology related companies that might that tend to have the higher growth attributable to them. And then there are the companies that are kind of the slow, steady Eddie growers that the private equity guys aren't willing to bid up for. They can't get their IRRs to work with a 2 to 3% annual growth associated with. So I think for good quality businesses in today's market, we are seeing aggressive bidding, and that's a function of the low interest rates and all the money, both private equity and debt, in today's market. But for kind of the good, middle of the road, steady growth businesses, they're not attracting those aggressive multiples that I guess the sellers would hope for.
Now, I know you guys have a very strong vertical in energy. Now, obviously, that's a pretty hot area right now, given the sort of energy boom here in the U.S. I mean, have you seen the demand go up in that sector? And presumably that's going to be a pretty aggressive place at this stage of the game.
You know, as far as private equity firm investment in energy is concerned, yeah, we have seen really over the last, 18 months, 2 years of continued strong interest in the sector in many different ways, and a lot of it, around the sort of the fracking play, everything from service providers to equipment manufacturers, several leasing companies that we've financed involved in leasing equipment to the oil and pipeline industry around fracking. So definitely that has been an area of interest.
Yeah, no, it's a remark. You guys must be spending a lot of time in North Dakota, I would think.
Luckily, we've got an energy team with offices that, in Texas and a few cities, as well as here in New York, and so those guys are on the road a lot. Yeah.
There you go. Better them than you. So in terms of the overall sort of mid-market looking forward into 2014, are you seeing credit demand picking up? I mean, with the growth in the U.S. economy generally is not, I guess I wouldn't call it robust. It seems to be slow and steady, I guess, is the way I'd look at it. I mean, and based on Jeff's your comments in the video, it suggests that there's really not going to be a major change in the credit environment going forward, again, due to the low interest rate environment and those kind of things. Mm-hmm. But one would expect, as the economy picks up, for sort of credit demand and the competitiveness, therefore, to increase. Is that something you're expecting? Does that make sense? Or do you have a different view on how overall economic growth is going to go?
Well, I certainly, at least through the first quarter, I think we've both seen a lot of new credit providers in the form of CLOs enter the market. So there's going to be that supply of money that will help spur the economy along. I don't think there'll be a shortage. I don't think there'll be a shortage of that, certainly, if that's your question about credit providers.
Oh, I was actually thinking about the demand side. I mean, are you seeing an upsurge in demand from at least in the sectors that you guys are experts in, in terms of demand side?
It's a good question. I think what I've been reading recently is that in the first quarter, I think I said it earlier, refinances and dividend recaps continue to kind of drive middle market leverage finance. At least I think it accounted for over 50% of dollars in the middle market. So that clearly is a function of I just think excess supply, and people want to put it to work. They're I guess using creative means. So refinance companies provide dividend recaps to good teams and provide capital for strategic tuck-in acquisitions to help build value for existing platform companies.
Yeah, which is not. I mean, that's good from the investor side of the world, or the management side of the world. But I mean, that seems a little bit disappointing in the sense of, it doesn't sound like there's a lot of growth investment. I mean, a tuck-in is a tuck-in, but it doesn't sound like it's a real aggressive growth strategy. It's more, getting returns back to the shareholders as opposed to investing in the growth of the business. I mean, am I misunderstanding that, or is that kind of what you're saying?
Yeah, but I think that's basic blocking and tackling of investing. I mean,
yeah.
I think you've got to do more. I mean, something else that I was reading is that the average hold period private equity firms have as far as their portfolio companies has continued to rise, and I believe is now over 5 years. I think if we go back, and I'm not exactly sure, but I would say that the data would support something far less than what the hold period is today. If you're holding a company longer, certainly you have to do more strategic things. You can't rely on market conditions to take you out.
Yeah, and Paul, to your comment about growth, investing in growth, I think I would disagree with a little bit with you if you're thinking that by all the activity was around returning capital. In fact, I think that the opposite happened. Not the opposite, but a growing trend over the last at least several quarters was around add-on business. Sponsors did more add-ons for portfolio companies over the last few quarters than they ever have, and so these are little tuck-in businesses that are certainly helping their overall businesses grow.
One of the things that sort of we focus on in analyzing sort of where people are at is the extent to which there's expansion into international markets, and obviously there's organic growth, and that is sort of domestically focused. And middle market companies tend to be certainly not exclusively, but tend to be domestically focused. Have you seen sort of a spike in interest in international expansion in your business?
I would say generally no. Sponsors, at least the ones that we cover in the middle market, they're already having a challenging enough time in the U.S. With the regulatory environment here. I think when you start doing things overseas, and that includes buying businesses based overseas, or at least businesses that have manufacturing or other operations overseas, that doesn't just multiply the complexity of doing business by 2 or 3. It's almost exponential, right? Because you've got different currencies, different tax regimes, different legal systems. Workers have different rights in different countries. So generally, apart from maybe buying an operating business based in the U.S. that has manufacturing elsewhere in the world, I haven't seen, I don't think Jeff has either, a lot of activity overseas by our sponsors.
Forgive me for saying this, and I mean, again, maybe I'm reading this wrong or interpreting this wrong, but there seems to be a sense of a sense from what you're hearing or what you're seeing in the marketplace amongst your own clients or prospective clients, a much higher level of caution, I guess, than we're hearing from other types of surveys and things. There's a lot of reports coming out from the Deloittes of the world and the KPMGs of the world and those guys, suggesting that there's a growing optimism and a growing aggressiveness and a willing to expand and all that stuff coming from the middle market. I'm not hearing that from you guys. I'm actually hearing a little bit more about it's a much more cautious approach that doesn't involve sort of big moves. Am I interpreting that correctly? I mean, is that sort of your feel as to where the market is at the moment?
Well, I'm not sure that conservative is the right word. I mean, I think we both touched on tuck-in activity being a very meaningful part of what's going on the middle market today, and that's helping spur growth. That's one thing. 2 things. If I want to use the word cautious, I think private equity groups are being cautious about what they're willing to invest, what types of companies, what types of sectors they're willing and interested to invest in. But I wouldn't say exactly it's cautious. And when we look at that activity, whether it's add-ons or whether it's dividend recaps, they're trying to do something to return capital. The longer they hold these assets, the more they want to return capital, the higher probability that they're going to attempt to raise another fund. And the way they do that is driving the most optimum internal rates of return for their limited partners. So I think we're both saying that there's certainly activity, but I wouldn't use the word cautious.
Well, I think if you look too at the number of platform investments done over the last period of time, it's down. Sponsors are really trying very hard to put big chunks of money to work, and they're not having as much success with that as they'd like, and so that impacts the amount of activity overall. And I think as well that kind of coincides a little bit with the amount of dry powder available. There's a lot of funds sitting on a lot of money that has that sort of ticking clock in their ear with their investment periods coming close to expiring, and they want to put that money to work, but they haven't been able to do it as much as they'd like in big platform type investments.
So why do you think we might say selective instead of cautious? We might say selective instead of cautious.
Yeah, I think that's a good way to put it. Yep.
Yeah. Okay. But why do you, again, I guess, why do you think that is? Are there any, it may just be a dearth of the right types of companies, I suppose, but I appreciate what you're saying about the investment period ticking out. That, to me, that would suggest, and again, I realize that you have to be selective or else you're not going to get the returns you need, but
right.
It seems to me there's an incentive to be aggressive. Given all of this, again, this confluence of circumstances, and it's interesting to me that the selectivity is still so pronounced, and maybe that's a good thing. I'm not saying that's necessarily a bad thing. It's probably a good thing. You don't want to waste the money, but it's just interesting to me that it doesn't seem as aggressive as I would have anticipated, or a lot of other voices are talking about. Any thoughts on I guess sort of why that selectivity is there? Is it because we have gone through this downturn and there's an uncertainty going forward in terms of a lot of these verticals as to what's going to happen, and maybe what are those uncertainties that you've identified?
Yeah, that's a big question. There's a lot of
yes, it is.
There's a lot that goes into it. I can tell you some things that contribute, and this is one of the things that I had written down to talk to you about, sort of maybe to sum up. But really, I think the regulatory environment that Washington has created really has a lot of businesses unwilling to invest or unsure about investing. People aren't hiring. They're not buying new equipment. They're not building new facilities. They're really watching to see, when does that economy for sure turn the corner and grow as predictably as everyone would like before they're able to spend those dollars. I think that's part of it. From our perspective as senior lenders, I think we're actually pleased to see the selectivity that Jeff mentioned on the part of our clients. These guys are sticking to their guns. Even though they've got money that's burning a hole in their pockets, they're being disciplined, and they are sticking to their strategies around the type of businesses that they invest in and the parameters that they will invest in and the returns that they need. And if they're not able to meet those returns, I think that's a good thing that they're being disciplined.
Be sure to check back for future episodes of President and CEO's Focus on the Middle Market podcast series. Thanks for listening.